afternoon. My name is Chris Paxson. I'm Dean of the Woodrow Wilson School, and I'm very happy to welcome all of you here this afternoon. Some of you may have been loyal followers of what has been a really incredible lecture series that we've had this semester. This is the sixth and final event panel that we're having on different aspects of financial market regulation and reform. And I want to introduce the panelists, but I really want to start by thanking the person who has been responsible for organizing this over the semester, and that is Jon Corzine, who is visiting the school as the John L. Weinberg Goldman Sachs Co. visiting professor. He does not need long introduction. I think all of you know that he has served New Jersey as a senator and as a governor. And we are incredibly fortunate to have him visiting here this year, and I just really want to thank him for everything he's done. I also would like to introduce our other visiting professor, Joshua Bolten, class of 76, who is here teaching this year and will be leading off some of the questions after we have our main lecture. Josh is also a John L. Weinberg Goldman Sachs & Company visiting professor. We have more than one right now because of some overlap. And as many of you probably know, Josh was the director of the Office of Management and Budget. He was George W. Bush's chief of staff, and he is currently co-chair of the Clinton-Bush Haiti Commission. And he's been just a tremendous asset to the Woodrow Wilson School community over the past year and a half, and we're fortunate to have him here. It's been really wonderful. So finally, let me introduce our main speaker, who, again, I'm only going to give him a short introduction because I think people know him very well. Paul Volcker. He is Professor Emeritus of International Economic Policy at Princeton, so we get to claim him as one of our own. We also can claim him as one of our own because he graduated from Princeton. He was in the class of 1949. And in between those things, he did some other kind of important stuff. He was chairman of the Federal Reserve from 1979 to 1987. That, as many of you will recall, was a difficult economic period for the U.S., was sandwiched in the middle of there, and he steered the economy through a very difficult period of stagflation and just has a wealth of experience. He has been very influential in recent policy debates about financial market regulation, and I'd like you to join me in welcoming him so he can give some remarks before we have Q&A. So welcome.
I'm not quite sure I'm supposed to stand up here and give something called a speech. That was not part of the deal. But in true Princeton fashion, I was asked to sign my life away before I know what it says here. You're going to have all the copyrights and recordings and photography. I don't know what you're going to get. But let me just spend 5 or 10 minutes maybe, because coming down here, it occurred to me the contrast with when I was entering Princeton in 1945. This building did not exist, and this auditorium did not exist, but the Woodrow Wilson School did exist. But it was such a different period. The war was just ending, and of course, the war. When I say the war, I mean World War II. The United States, of course, came out victorious. Europe, or England, was in a way victorious, but Europe was shattered. Japan was shattered. It was a different world in which the United States was clearly dominant and the leader. We had potential political problems and security problems with Russia a few years later, but it was a world in which you came here and either taught at Princeton or came to Princeton and you thought you were with the world's leading power, or you were going to be part of a world in which the United States was dominant. And let me tell you, that is no longer true, and I've been in some meetings the last few days that have just impressed itself upon me. And a visit to Asia a few weeks ago impressed upon me even more that the United States is not in the position that it was in, not just in 1945, but not in the position it was in when I was chairman of the Federal Reserve in the 1980s, or what the position I was in country was in 1990. I was at a meeting where they had, I'm not a PowerPoint guy, I was, they had a PowerPoint, but you won't be able to see this, but these nice colored charts show the relative position, economic position of different countries and different continents since 1990. And there was the United States, no longer 50%, but 21%. Western Europe just about the same at 22% altogether. Those were the high 1990. I actually wrote a book here at Princeton when I was a professor with my Japanese friend Toyo Gyoten. The name of the book was Changing Fortunes. And the changing fortune we were worried about, I was worried about, he was probably triumphant, was the rise of Japan. This was when Japan was #1, and years of growth of 6, 7, 8%. Well, the United States has been through a difficult period, and the economic challenge, if it was a challenge, was from Japan, and Japan then had 9%. Relatively small country, 100 million people, 9% of the world's GDP. Then we come to 2008, just after the crisis. This is in purchasing power parity, I'm sure, but the United States is still 19%. Western Europe has slipped a bit, 17%. Both of those numbers are lower. Japan is only 2/3 relative to where it was. Japan immediately, as soon as we wrote the book about how it was speeding up, it's had a very sluggish 20 years, which is maybe a lesson for the future. But China, which in 1990 was 8%, is now 18%. Not so far from the United States. This is obviously per capita, the income is much lower, fraction of our lives per capita, but when you have 1 billion people, it does add up. And in purchasing power terms, our country is now pretty close to where we are by these figures. But the startling number is a projection ahead to, no PowerPoint, but I can turn the page over. Here we are in a projection for 2030, 20 years on. I won't be around. The students will be in midlife, and you know, but you're not going to be in a world in which the United States is just automatically the leader of the world, according to this projection. China, economically, will be twice the size of the United States. India will have come from a fairly small fraction to close to the size of the United States. Now, those two countries together, of course, are 1/3 of the world's population. Japan, which was 9%, back when we wrote that book, squeezed that down to 3%. So it's quite a different world. Europe, according to this projection, less than the United States. Europe's only about 1/3 of the economic weight of China, if you believe these figures. So it is a different world, and it's not only a different world in the size and whatever that indicates about power, but I'm not telling you any news when I tell you it's not only a complicated world, but a difficult world. Here we are in the midst of the greatest recession we've had since the 1930s, right on top of the biggest financial challenge. Maybe the recession's on top of the financial challenge, one way or another. We have had what can only be called a collapse of the financial system that we were so proud of a decade or so ago. It collapsed, and I think that strong word is appropriate. And there is all kinds of evidence that the combination of a recession and that degree of financial collapse spells troubles for some years, a very slow recovery. The latest figures that we saw for the unemployment number just on Friday and the growth in employment, another confirmation that this is a very slow recovery, which means we're not going to go back to the level of employment we had before the recession for some years, and we will not retain a strong growth path. I won't project when, but it's not going to be very soon. We can get into a lot of that. in the later discussion if we want to. But this has been a period, these last 20 years or so, particularly of globalization. It's not new, but it's increased to a point that we haven't seen for decades and decades at any rate, and particularly a globalization of financial markets. And interesting thing, of course, is we have this wonderful efflorescence of financial markets around the world, and here in the middle of the world's financial system we had this breakdown of the markets. There is, I almost hesitate to say this, but globalization was looked at was a matter of great promise, open markets, competition, all the rest. Certainly the financial markets glorified in globalization. And we have had an enormous benefit from globalization in other countries. The so-called emerging economies have done very well during this period. While we have had a sluggish economic, had recession, and a not particularly favorable economic performance earlier in this century, and an economic performance marred, in my view anyway, by the fact that typical household income in real terms has not increased for 10 years or more. Well, we've had an enormous increase in compensation at the top of the income scale. And this isn't a matter of the top 25% doing well and the bottom 25% doing poorly. It's the top 2 or 3% doing well. The top 10%, which includes the top 2 to 3%, has gone up. But it's really a very concentrated phenomenon with 1% or less of the population having gains in income that are just without precedent. So you wonder a little bit about the stability or payoff of this globalization, if it's been very favorable for some countries, not necessarily so favorable by the United States by today's evidence, and certainly not very favorable in terms of the income distribution that's accompanied it. So clearly we have a big imbalance in the world economy. You didn't see any economic analysis, any talk, even as recently as 10 years ago, that the emerging world would be the economic triumph story of this particular decade, of this particular century. It was in the mid-1990s when we had a very bad economic collapse in Asia. Asia financial crisis spread to Latin America, spread to China, to Russia for a while. That was a bad crisis, but it was a kind of typical crisis. The developed world was called upon to assist the emerging world to get out of trouble. And we lent a lot of money, and marshaled official funds and private funds, but that was 15 years ago. What's happening now? Oddly enough, the emerging countries are financing the developed countries. And that is most evident in the case of the United States. We've been consuming, we've been spending, we haven't been investing much. Until the recession, we were saving practically nothing. And those poor Chinese, all a billion of them, or some of them anyway, were indirectly or directly financing the United States. A very strange phenomena that I think is kind of something we have to worry about. It's an imbalanced economy. Not only are we in recession, the whole developed world to some degree is in recession with few exceptions, but it is an unbalanced world, and that needs to be corrected. Now let me just say, and he's not very optimistic, I guess, opening remarks, but we have a future. Well, you all have a future. My future's shorter than yours. But I don't think this world works very well. I come from a particular era, but the United States has been, I think, a constructive, relatively benign leader of the world in opening markets and developing technology and innovation and, broadly speaking, growth, even though in the last decade or so, Other countries have done better at the rate of growth and are rapidly catching up to us. But how do we manage this world economy now? A much more difficult situation. We're not sitting there with 50% of the world, and we still have a military force that looks like it did in relative terms back then, but economically, I'll tell you there's a difference. When you go to an international conference now, it's no longer the United States automatically at the head of the table, kind of suggesting to others what to do and hoping to get some cooperation. Right now, you don't know where the head of the table is. The United States is there, China is there. I tell you, from experience of a few weeks ago, China isn't just blithely saying, oh, what do you want in the United States? How's your financial system? How do we run our financial system? Should we use your financial system as a model for ours? Not anymore. They said, we think your financial system's got lots of problems. We'll talk to you about that. Look at this meeting in Seoul. I happened to be in Seoul right at the time of the meeting. I won't get very complicated, but the United States would enter that meeting thoughtfully thinking that they had presented an analysis of the world economic imbalances, and particularly the need for Asian countries, and especially China, to make some adjustments in the exchange rate or otherwise to help balance things. They presented a rather sophisticated analysis that said this is a multilateral problem, we all got to get together. The finance ministers had met, and there was some consensus on a general approach in that manner. What came out of that G30, G20 meeting a few days later was China, together with Germany, triumphantly telling the United States what to do. And why was the United States flooding the world economy with excessive amounts of liquidity and stop talking about what we should do? We, the rest of the world, are looking to the United States to change their policies. It tells you something about not just the state of the world economy, but the state of the world political situation. And it is going to be a situation that's a lot more challenging, I think, in the sense of getting some coherent leadership to deal with these very severe economic and indeed political problems we have. Now, having said that much, I want to express my faith that it better be the United States that gets its act in order so that it has a little more influence than it has in the moment, because I don't see any other country or group of countries or whatever that are going to kind of take the constructive, I think, relatively benign role that we had in most of the days since I was entering Princeton and the Woodrow Wilson School. I probably talk twice as long as I promised, but I will sit down. You're going to assault me, Josh, or assault the audience or something. Thank you.
No assault, Mr. Chairman. You're still a lot bigger than I am. Mr. Chairman, thank you for those, if not uplifting, at least clarifying comments about the state of the United States position in the world. You mentioned your work on Japan when you were here. Some economists see Japan Japan's situation as a harbinger of what the U.S. may ultimately be facing, albeit coming from very different kinds of situations. What lessons should we take from Japan's miserable experience over the last 10, 15 years of profound stagnation, even while the rest of the world was growing? And what should U.S. policymakers do that keeps us from becoming the Japan of the future?
Well, actually, the first thing I'd say, I think there's been some misreading of the Japanese experience. It's not been terribly uplifting in the last 15 years, but it's not really as bad as a lot of the commentary suggests. And the reason I say that is you forget the Japanese population is declining. It's a phenomenon that doesn't happen very often in peacetime. And I don't remember the numbers exactly, but I think it's been declining maybe roughly 1% a year. And the growth has been, let's say the growth during this period averaged, I think 1.5%, something like that, which is bad, 1.5. But if you say 1.5% growth, and 1% decline in population, you've got 2% plus of per capita growth, which isn't very far from what we have. When you correct for, because all population is growing, it's 2% a year, certainly 1.5 anyway. So the Japanese pattern has not been great, but it also isn't as bad as some people have presented it, in my view. And it's reflected in the fact that while their unemployment is up, it's up for, it's ranging 4 or 5%. That looks pretty good by our standards. Currently, typically in the past, their unemployment rate's only been 3% or so. So it's up, but it's not as bad. For all that, they're kind of disparities. But when we draw the lessons, a lot of talk, the trouble with Japan is prices are not going up. Prices have actually gone down. They have a deflation. And it's true for most of this period, not all of it, the prices going down. I don't know what index you look at, 1% a year or so. But I think it's a misreading of the kind of sluggishness in Japan as a reflection of the price level. That's not the usual interpretation. Japan and the United States share a similarity. We both had huge bubbles, excesses in two markets. The stock market first and the housing market later. Now ours came with a little separation in time. Theirs came at the same time in the late 1980s and early 1990s. They're very similar in a way, but our stock market went down 50, 60%. At the bottom, theirs went down 75, 80%. Our housing market went down 30%. Their real estate market went down 75%. I'm saying that they were very similar shocks, but theirs was even more severe than ours. And they didn't have such a complicated financial system, but these events basically bankrupted their banks. And the banks succeeded because the government has an organ to protect them and guarantee their liabilities, and in some cases put capital in. Kind of similar. Less messy in Japan because the whole financial system was largely banks. And that made it, in a way, a little easier to handle. But it had similar repercussions. It was a great shock to the financial system. We had a great shock to the financial system. Both financial systems stopped lending for a while for understandable reasons, and it gave rise to economic sluggishness. And actually a big recession in the United States, kind of overall sluggishness in Japan. But I don't think anything of that had all that much to do with the fact that part of this period the prices were going down. This image of the trouble with Japan, the proverbial Mrs. Watanabe was waiting to see prices go down 1% next year, so she didn't buy anything. It's kind of phony. I mean, I don't know how many of you put off many purchases because you thought the price index might be down 1% next year. Just about the 1%. Yes, you're going to go buy it now. So I think there's been something of a misinterpretation, which is not unimportant because I think it's been misinterpreted by American policymakers.
Let me ask then about Japan's bigger and much more important now neighbor, China, where I think you will find that is at the crux of the policy problems that policymakers face, and was at the crux of the Seoul G20 meeting that you mentioned, where everybody, the one thing everybody seems to be able to agree on, both at those meetings and in the academic context, is that we have deep imbalances in the world economy that need to be addressed before the economy is healthy for any of us. Too little consumption in China and too little savings in the United States and the developed world. How big a role does Chinese currency manipulation play in that? I.e., would you be willing to say that China is a currency manipulator, number one? And number two, if
cameras are running, right? The cameras.
That's why the chairman had to sign that release. And number two, even if you don't want to say that they are manipulating their currency in a technical fashion, what, if anything, should U.S. policymakers do to address what most people perceive is an overvalued Chinese currency that is contributing to the imbalances in the global economy?
Well, I think this business about whether it's a currency manipulation. Currency manipulation in this context is a politically loaded word, which what we do know is that they are actively maintaining reasonably stable exchange rate with the dollar. Actually, it's very troublesome that while the Chinese RMB has gone up against the dollar, not very much, it's gone up against the dollar in the last year or two, it's actually gone down compared to many world currencies, including most particularly the Japanese currency, which is their biggest developed country trading partner. Now, it just so happens I can answer your question because I spent 15 minutes just this morning listening to the explanation from the Chinese point of view from one of the Chinese leaders. And their argument, first of all, is China's a big country in population. They've been growing very rapidly, but they still have about 300 million people living in poverty, who they are rapidly trying to bring into the 21st century, but still have a long ways to go, and it's important that they maintain this enormous thrust of growth. Now, that growth is too dependent upon exports. They would readily say that at this point, but it takes us a long time to make the necessary adjustment. That's concerned, and we don't see much evidence. This is an interesting intellectual debate. We don't see much evidence that changing the exchange rate alone is going to do very much about speeding up the adjustment that we, the Chinese, must make in encouraging relatively greater consumption and counterpart is less savings. To give you an idea of the contrast, the wonders are wonderful. Consumption in the United States at the peak, beginning of the crisis, got up to 70% of our GDP. Traditionally, it's been about 65%. At 5% increase in consumption is about equal to what our trade deficit was, which was a large part of Chinese exports to us. Chinese consumption is unbelievably low relative to the economy. With this great burst of growth, consumption in China is just half of the rate of consumption in the United States. We have 70%, they have 35%. Now that represents a considerable imbalance, which is reflected in the international imbalance, has to be corrected. But they are obviously quite resistant to moving faster. On the other hand, it's all kind of symmetrical. These other countries look at us, including in Seoul. We didn't expect the spotlight to be turned on us, but they're saying, what are you doing to increase your productivity, and particularly what are you doing to correct the financial excesses that we still see coming out of the United States as epitomized by a deficit of 10% of the GDP. And we don't see any evidence on your part that you're moving any faster than the Chinese are moving to deal with their imbalance, to deal with your imbalance. and there's some truth to both of those propositions, I'm sure. But it's indicative of how difficult the situation is around. I think the Chinese own interest to move the exchange rate more rapidly to help with the adjustment process. But I don't think it's going to bring in itself any massive, it's not going to reduce their external surplus and recovery. Unless the rest of the world is doing things in a complementary way. Very close. Well, maybe I didn't want to express that.
That was an extraordinary insight.
A few folks. Let's actually start with students, if we might. Woodrow Wilson students, if you would like to pose a question, please come forward. By the way, before it is all over, one of the passions of Chairman Volcker's life has been the promotion of public service and work in public service. And I think it's appropriate that someone who has been dedicated to the Woodrow Wilson School of Public Service life is here today, and hopefully these kinds of interchanges will encourage the kind of high-quality young people going into public life, public service, that I think the career of Chairman Volcker so eloquently epitomizes. Please.
Hi, thanks for coming, Chairman Volcker. I was wondering if you could talk. I was wondering if you could talk about the financialization of the United States economy, the much greater percentage of corporate profits going to financial companies today, sort of what you view as the causes of that trend and the consequences, whether you think it's going to reverse itself in the wake of the crisis, or whether it will persist and be a permanent feature of our economy.
Well, I have to confess in answering that question that it's not a great secret that I have not been a primary admirer of developments in the American financial system in the last decade or so. You are right that at the peak again, profits in a fairly narrowly defined definition of the financial sector got to be 40% of all profits. There's a wider measure of the contribution or lack thereof from the financial system. It's worth looking at. It's a little more complicated. If you look at so-called value added, in terms of value added, presumably meaning what a particular sector has contributed to the total GDP, and it's basically made up of wages and profits. You say high wages, high profits, high income, that's how value added. I won't recall the exact years, but if you look at that in nominal terms, without any adjustment for prices, in a 15-year period or so, maybe a little longer, the financial contribution to GDP, measured by value added, almost doubled. If you look at it price adjusted, and I don't know how they make the price adjustment, frankly, but it's interesting. If you look at the deflated figures, it didn't increase very much anyway. I think it was 8% or so, and might have gone from 7 to 8%. The other figures went from 6 to 12 or something. But it raises a question of whether the activity and the enormous profitability of the financial market, how much it really contributed to the growth of the economy. Now, we have a few PhD students here, I guess, maybe one or two in economics. I have offered a prize for the first PhD student that can produce a dissertation that convincingly tells me that the expanded financial markets contributed to greater productivity and growth in the American economy during this period. So far, I've had no takers. That's time for, I know, dissertations to be written and so forth, and it's a difficult question. But I do think we had a little elephantiasis in the financial system. For, I don't know, a variety of reasons. It's a period of enormous innovation. There's absolutely no doubt about that. And this enormous innovation paid off in high profitability and high incomes for some people participating in the innovations. But I think the question remains as to how much these innovations really led to a better economy. I know the story that all this innovation was necessary to manage risk more effectively, and we were going to diffuse the risk, and markets were going to be kind of fail-safe. These derivatives we had, and all the various techniques for maximizing profits, is what I'm telling my mouth, to protect the economy. But when we got in trouble, we found out that risks weren't so diverse at all. It's not so far separated. A lot of them were pretty concentrated. And the markets got so complex and so interrelated that they kind of fell apart under pressure, which obviously leads to the need for a lot of reform. But, you know, it was a very attractive period. Everybody would say now that bright people in every business school, and I'm sure I wonder how many graduates of the Woodrow Wilson School ended up on Wall Street instead of in public service. I remember a little anecdote. When I came to Princeton to teach up there, was in the Federal Reserve, I had given a little office in the building across the street, which I forget for the moment, but I mean, I had a little office, somebody knocked on the door and said, could I talk to you, and I want to get your advice. And I said, okay, what's your background? No, I said, what's your question, man? He said, well, I want to go to Wall Street, and I just wonder which firm is best. Which one? I guess you had a couple of offers. I said, well, what's your background? He said, I just got a PhD in aeronautical engineering. I said, why are you debating about which Wall Street firm to go? We just got a PhD in aeronautical engineering. He looked at me as if I were out of the moon or something. He said, don't you understand? If I go to Boeing, now this is 15 years ago, if I go to Boeing, I get a job right away. It'll be for $40,000 a year. And when I'm a senior engineer at Boeing 25 years from now, I may be making $80,000 a year. And if I go to Wall Street, I'll make that in the first quarter. And Paul is just, you know, aeronautical engineers who's everybody. And, well, if you really go on my lectures on financial markets, it attracted a lot of very competent, I guess, this engineer, but civil engineers, other engineers, and particularly mathematicians and physicists who were adept at mathematical analysis and techniques. And they thought that they could apply to financial markets a lot of the techniques of analysis that are familiar to mathematicians and physicists and so forth. And they made a lot of money to some extent in doing it. And they developed, presumably, not fail-safe, but a risk management techniques that were supposed to analyze what went on. And second allowance for risk and how probable certain events were. And then you increasingly found out as the thing collapsed, you know, all these events were happening that were only supposed to happen every 100 years, or every 50 years, according to their analytic approaches. And I began to raise some questions about whether the analytic approaches were based upon the right premises. And I think the answer to that is they were not. Because for all their sophistication, they forgot a simple fact, that financial markets are not a physical phenomenon. It's not like flipping coins and giving the probability of how often heads are going to come up and tails and nice. You know, a mathematician, in my view, He raised in his head, the whole world looks like a frequency distribution. And that's what the reason the financial markets work. But financial markets are human institutions, and the characteristic of a human institution is they look at what happened yesterday and decide what to do tomorrow. Or the financial markets, they look to see what happened at 12:01 to see whether they can make a deal by rapid trading at 12:02. But this is all a human reaction that leads you to ups and downs. It leads you to evidence of following the leader or following the market, and carrying it to extremes, and then following it maybe in the other direction. So you get a degree of fluctuation that the analysts have to put into their model. And because it became contagious, you have all the human, as well as mechanical contagion in the markets. It became very dangerous, and obviously has to require another regulation. But nonetheless, we have financial markets about to do pretty well, and making a lot of money again. I think the necessary adjustment there has not been completed. There's nothing in the world of financial markets, not all that sophisticated, that says a lot of what needs to be done very well in financial markets is going to have a rate of return of 20 or 30%. A lot of more basic stuff probably should have a nice regular return of 10% or 8% or something. And the effort to make all the returns 25% leads you into a kind of activity that in the end breaks down. I guess I won't just I really kind of back a year or so ago we got some attention that the only innovation in the financial markets that I thought contributed to productivity was the invention of the automatic elevator.
This one's a live joke. Let's get it.
You won't repeat that. I'm sorry, I'll hang on to the microphone.
You might repeat though, but only financial innovation.
You know, all this stuff about all the financial innovation, I told you about my skepticism, a lot of the financial innovation. If you want to worry about financial innovation, credit default swaps were only invented in 1995 or so, from scratch. Nobody ever heard of a credit default swap. And they were invented by, obviously, some very clever people who had a particular problem in mind, which is a legitimate one. How do we hedge against particularly a corporate loan or a corporate security? And if we develop this so-called derivative, the value of which is kind of an insurance protection, how much are you willing to pay somebody to protect you against an adverse movement in that credit? Sensible idea. And it was developed, as they say, in 1996 or something like that, from nothing. By 2008, the nominal value of these debts being protected was $60 trillion. And the volume of the debts that were there to be protected was more in the order of $10 trillion. So you wonder what use was being made of this instrument, kind of an insurance instrument, provide 6 times the amount of insurance on the value of the security to begin with. There may have been some excess in that. It brings me like on automatic teller. I was at a meeting and I was griping about all this. And it happened to be a pretty well reported meeting. And people at the meeting were talking about, this is a couple of years ago, talking about the need for reform. These were a bunch of financial market people. And the reforms they were talking about seemed to me milquetoast. I mean, put it that way. They say, well, we're going to have better corporate governance. And the chairman or the board of directors ought to do a better job and this kind of stuff. And I didn't think that was going to answer all the problems. And I gave up and he might harangue about financial markets. And they all say, well, you don't appreciate the importance of all the innovations we have and making the world go round and so forth. And you just, I kind of get irritated. And I say, the only invitation in financial markets in recent years that I have any sense that contributed to the real productivity of the economy was the automatic teller machine.
I was just wondering if you could give us your reaction to the Fed's policy of quantitative easing.
Well, I know one thing I don't do. Microphone's on or off. I mean, kind of common courtesy among thieves or whatever. Federal Reserve people not to try to outguess the present incumbent. But let me say what I will say about that. We obviously, you know the economic situation we're in. Very difficult with the prospect of very slow growth. I don't know how many of you heard Senator Nanke last night on 60 Minutes. I avoided going on 60 Minutes like the plague. And I was chairman because I know how they can cut you up if they want to cut you up. But he decided to take the chance. He did very well. He was great up front, explained what he was doing. And what I will say is, I'm to be consistent with this, you got this QE2. I mean, I am so old, I went on the QE2. This is a Japanese term, which I never particularly liked. It was meant to convey, we've got interest rates down towards zero, and we're still going to pump up the money supply, and that was called quantitative, I guess, because they couldn't get the interest rates lower, but I didn't object to the policy, I just don't kind of like the term. We've adopted it, obviously, the world has adopted it. And this is done with a lot of anticipation, big headlines, and so forth, when it was done. But what it is, in this iteration anyway, they're buying long-term treasury bonds. And the hope, clearly, is to get the long-term treasury bond rate as low as they can possibly get it, in the hopes that the mortgage rate will then go down, and the mortgages will be a little cheaper and more available, and they're doing what they can to try to speed up the economy. Now, I don't know how effective that will be, because there isn't much leverage left in interest rates. But the idea of the Federal Reserve buying treasury bonds doesn't bother me, because my particular history anyway, I joined the Federal Reserve Bank in New York when I got out of graduate school. Actually, I got joined when I got out of Woodrow Wilson School. And in those days, the Federal Reserve bought treasury bonds as kind of a matter of, not in the volume that they're talking about, but it was part of normal policy. If you wanted to get long-term rates down a little bit, you bought some bonds. If you didn't want to get them down a little bit, you didn't buy the bonds. And it was kind of an ordinary thing. So the idea of buying treasury bonds is not shocking to me. And it's understandable. I question how effective it will be. But it's been dressed up in this package, and they want to announce it, over a period of time. But I think it all comes, compared to what the Federal Reserve did in the midst of the crisis, where they were taking actions without precedent, way beyond any normal central banking action. This is nothing, in my view. It's a reasonable approach. You can debate back and forth, but it's the amount, again, going back to Seoul, it was unfortunate, I think, in the timing, because the foreigners and the Chinese, most of all, wanted to interpret this as a deliberate effort to push the dollar down, which I do not believe that it was.
It didn't work very well.
Well, it didn't work very well. It didn't work very well to get the interest rate down either, I must say. But I know enough about how the Federal Reserve operates to know that their concentration is not on manipulating the dollar, it's to try to get the American economy moving. But, you know, when we got into the Chinese, it's partly because Germany is in somewhat the same position as China. China in the world economy, Germany in the European economy, are being accused of being too efficient, too disciplined, too much surplus. So they were feeling under pressure from their European friends. But we were getting more criticism about trying to manipulate the dollar or depress the dollar than they were getting for having an overvalued currency. And it kind of slipped around.
Please.
I have a question regarding China's currency appreciation issue. I've read an interesting article on Professor.
I can't.
I have a question on Chinese currency appreciation issue. I've read an interesting article on Professor Becker's blog about China's currency appreciation. And he said that the US and China should have been arguing opposite positions on the currency appreciation issue. Should have been arguing opposite positions regarding the China's currency appreciation issue, because China, by devaluating its currency, is actually benefiting American importers and consumers, whereas the target that's been hit most dramatically by Chinese devaluation of its renminbi are American exporters. So, and in opposite, in China, by keeping its value down, China has been hurt by expensive exports, and China, by buying a lot of foreign reserves, have placed itself at the mercy of the United States, inflating away its asset, inflating away the debt for China. And I was wondering, what's your take on that view? That they should have been arguing opposite positions on this issue.
You know, that's an American criticism. I say it's an American criticism because we like to consume. And it's true. China maintains an undervalued currency and has a lot of exports, but keeps their currency cheap. The consumer, who might benefit from imports at a cheap price, are being hurt. That's true, but it doesn't seem to be a particular worry for Chinese economic managers, because they have other priorities in mind. I think an argument we do make and should make is that it is consistent with the Chinese professed objective that over time, to bring up their consumption and help their consumers, an appreciation of the RMB would help that. And I'm not sure they would deny it. I don't think they would deny the analysis, but it comes down to all kinds of arguments of how you do it, when you do it, what else you have to do. And just to give you the narrowest kind of technical question, when it comes to revaluing the yen, the RMB yuan, a lot of economists would say there is a considerable economic opinion that to really make an impact, they better talk about something like 20% or more. And if you do it gradually, you might make things worse, because people will keep expecting that it's going to go higher, so they'll begin speculating more and more. Once they said they will accept some revaluation, it will only encourage the speculators and make their job even more difficult. And I think that is a problem for them. Now they are maintaining controls on investing in China, at least investing in currency. And we keep talking to get rid of those controls too. And they say, well, you want us to appreciate the RMB, at the same time you want us to get rid of the controls, and we're going to end up in a mess. Because they say I think you have some sympathy that if we did it all in 20%, all in one big jump, it would create, that's enough so it would create real problems for some of their export industries and impair their growth rate and all those 300 million people that they want to get more productively employed. And I think that is a legitimate concern on their part. So this is not a easy question.
Is this on? Okay. Thank you for coming, and also thank you for your service to the Obama administration and your service to the federal government in America for decades. I would like to talk particularly about some of the ideas that you've put forward. You seem to be rather critical of the role of finance in the economy, as opposed critical of the value-added role of finance in the economy.
Oh, yes.
The financial sector. I'm just trying to be like, is that a fair characterization? Yeah. Oh no. So sorry. So a lot of people, when the financial regulation bill was being debated, and a lot of ideas of yours, such as the Volcker rule, and your influence was very helpful. A lot of people were the political process looked to academic institutions like the Woodrow Wilson School and for guidance about our policy. However, others have noted that just as there's a large interchange of people from these investment banks that are being regulated in and out of government, there's also an interchange in and out of academia. You have Frederick Mishkin at the Columbia School of Business that got money from the Icelandic banking Chamber of Commerce in exchange for papers written about their banking sector. On the far more innocuous side, you have regulated banks that you have professors investigating the regulation of investment banks, holding professorships sponsored by those investment banks. I say far more innocuous. I don't, mean to offend, but do you see any legitimacy in those criticisms that beyond the academic research, there might be a conflict of interest or harm in the influence of regulated financial institutions on the academics who research them and advise policymakers?
Well, I think, it's always been true, I think, probably due to the complexities, there are lots of conflicts of interest in financial markets and inevitably in the relationships between people that have a lot of money and academic institutions and others. You just have to be as alert as you can to that. I must say, I think business schools in particular got caught up in an academic theory about economic society and financial markets in particular, that they were efficient, self-regulating, somehow possessed of rational foresight. And that was a very persuasive view, promulgated by a lot of academic institutions. I think it wasn't, you can argue which way the influence was going. I'm sure it was a nice, convenient rationale for financial institutions, for regulators. We got caught up in that kind of approach that the market could take care of itself, and counted on the market to protect itself so you wouldn't have the kind of crisis that we had. And I think that has kind of been, people don't argue that much anymore. I think business schools, most of all, are caught up with that because it's been very profitable with business schools. Business schools want to attract students. They charge a lot. It's a very profitable enterprise for universities. You can help pay the bills for the rest of the universities, like football teams. And so this was kind of an attractive doctrine because they wanted to get students, I think not consciously, but it was consistent. They were training people to enter the financial markets in large part. And, you know, I remember personal anecdotes, but a friend, not a close friend, an acquaintance who teaches at the Harvard Business School wrote me a very plaintive email 6 months ago or so, and kind of worrying about what was going on in financial markets and whether people had lost their sense of, in some cases, ethical sense, concerns about conflicts of interest and what was going on here. And I just sent him about a short note. I shared his concerns. But where was Harvard Business School during all this period? And he sent me back an equally short note. You have touched a sensitive point. And I think it is a sensitive point for the educational establishment, including the business schools. They did their part in propagating an economic doctrine that didn't turn out so well. And now I think it's being corrected. The saving grace here is economists always like to criticize what the previous generation thought. So we're now at a stage where the newest crop of economists will break down the theory that we had 20 years ago. But all that takes time. That is going on quite visibly.
First, I wanted to thank you for coming. I'm a senior and I'm not an econ major, but when I took macro, the way they taught it is they said, Chairman Volcker broke the back of inflation and caused a great recession, and now they admire you for it. But I'm sure at the time it wasn't so popular. I wonder if you could talk about your personal experience during that time, what it was like dealing with the pressure, and then also institutionally and personally how you dealt with it.
Well, let me tell you how I guess I deal with it. Personally, I convinced myself very long, I think correctly, that the United States was headed for economic trouble when I became chairman of the Federal Reserve. That was no great secret. I mean, it was a general feeling that the economy was in real trouble. And in real trouble, most explicitly because the inflation rate was high and accelerating, and the economy was not doing well. The theory that the economy is assisted by a feeling of inflationary expectations may be true in some limited instances, but that story had worn itself out by the end of the 1970s, and people, including me, were pretty well convinced that unless you dealt with the economy, we're going to have an economic breakdown, a recession of some sort. So I don't accept the analysis that the Federal Reserve policy created the recession. Now, obviously, it contributed to the particular timing of the recession and all the rest, but I think we would have had an economic problem whether or not we had had these extremely high interest rates. I will believe that to my dying day, yes. But I happen to think it's true. But we survived that period. I survived the period. The Federal Reserve survived that period, I am convinced, because there was a lot of angst and a lot of pressure in some ways, a lot of complaints and threats and all the rest. But I think I would not have wanted to run a beauty contest in the whole country and have a vote. But there was a kind of common sense core of opinion in my feeling that people recognized something was wrong. They kind of had the sense that the fellow who was trying to deal with it, so they'd give us a certain amount of rope, so to speak, because they thought something pretty painful probably had to be done to correct the problem. It was helped. I had a lot of talk about President Reagan, and I didn't have close relationships with President Reagan, but he did not criticize us, which was, he did not personally criticize us. People did. He didn't, but I think he had this kind of gut feeling that inflation was bad, and rising inflation was even worse, and that he understood, without being very complicated about it, the fellow was trying to do something about it, and he wasn't going to bitch about it when he thought we were trying to deal with a real problem. And I think he, of course, I think he was right, but I think that's what happened. You can't conduct a difficult public policy and a difficult monetary policy if you don't have some understanding in the part of the country. And you don't have to have a popularity contest, but if people clearly don't understand what you're doing at all and why you're doing it, you're in big trouble. And I think we had that kind of common sense. Support.
Sir?
Yes, Chairman Volcker, like everybody else.
Speak up.
Yes, thank you very much again. Like everybody else for coming here. I met you 28 years ago in D.C. as a Princeton student, and you were as candid then as you are now. I appreciate that. Question. It doesn't relate to a current Fed president, but it may have related to one of your successors who said that you really don't know you're in a bubble until it pops. A bubble. You don't know you're in a bubble until it pops.
Ah, yes.
And I was wondering if you could comment on that, whether maybe you might have been able to tell that we were in a bubble.
Right. Well, I can on a lot of ones, although I could tell I have a couple of speeches where I was suggesting that you were in trouble before it popped. But, you know, it is a hard thing to, you know, in retrospect, it's very easy. But at the time when things are going well, you know, there's always a plausible explanation as to why it's happening, and don't prick the bubble because you don't know it's a bubble. And, you know, in our case, it's a wonderful thing to have home ownership and stable for society, and isn't it wonderful that we found techniques to expand home ownership to people who otherwise couldn't afford it. So this is one instance. Or earlier with the high-tech bubble in the stock market, you know. Well, this is a new world. This is no bubble. This was, you know, Dow Jones at 32,000. You know, you're full of anecdotes in your old age. I was a visiting professor at NYU in the Stern School, the business school, a while ago, which meant I occasionally went to a class, and, you know, taught and so forth. Attempted to teach. But I was in this class, and these were second-year MBA students. In the Stern School, they are likely to have had some considerable experience in finance when you were at that stage. So these people were probably in their late 20s on average. It was right at the end of the semester, at the end of the class, and I was just trying to think of something to do before the clock rang to get out of there. And I said, all right, how many of you here think, I said, look, the stock market is going up at an annual rate of 15% for the previous 15 years. It was 17% actually. And now looking ahead 10 years, you're all going out in Wall Street, looking ahead 10 years, how many of you think the stock market will go up more than, and I picked out a figure out of the air that I thought was ridiculously high, following some. How many of you think in the next 10 years the stock market will continue to go up at a rate of 10% or more per year? Every hand in that class. And Copeland said that, you know, I expressed some surprise. I said, well, we didn't say it would go up every year, but you asked us on the average what it would go up. Well, it so happens we're just about 10 years from when I asked that question, the stock market's going up 0, which tells you something about how hard it is to appraise trends and what's excess and what isn't excess. But you're not going to cure all these things by traditional monetary policy in any sense. Many people have said, and it's got, take the housing thing, could you have killed the subprime mortgage phenomenon, the housing bubble, by monetary policy? You probably could, but given the mood at that time, it would take a very stiff dose, arguably, of monetary policy to do it. It would have been the same argument you can make about the stock market earlier. So maybe you need another tool, and I think that's fair, and I think a lot of the discussion of financial reform and regulatory policy accepts now, it's become suddenly common wisdom, that there can be bubbles. They're hard to detect, but you've got to be careful about them, and you ought to be able to use regulatory policy to moderate the tool more directly than you can in combination with monetary policy. But why didn't, in retrospect, somebody go in there and say, this business is 3% down and no checking the credit standing is ridiculous. And if you're a bank, we're going to put you in purgatory if you continue to do that. But nobody did it. But I think that's a lesson that's been learned for the time being anyway. Now the next bubble will be something we haven't dreamed up yet, I'm sure, and it'll still be difficult to tell, but I think we've learned something about hopefully making it less likely that it gets too bad in the future. More important than most of the talk about reform is how to strengthen the market so that when it happens, you don't have the disaster we had this time.
In the news lately, we've heard them talking about extending President Bush's tax cuts. And I'm wondering, what do you think would create more jobs in this country? Extending all of the Bush tax cuts or going back to the industrial and tariff policy that we had for the first 150 years of our democracy?
Well, I will tell you what my personal view is on this. It has no influence on anything. I would say, okay, Congress, we're going to, given the fact that we're in the middle of a recession, we'll probably have to reverse this before too long. We'll let, well, I think we need much more profound tax reform. But I'll go, given the present situation, middle income people and below, and I don't exactly know what that number is, but the president stuck 250,000. I say they can keep their tax reduction, but these rich guys don't really need it. And I have hard to see the connection between their behavior and change in the tax rate there for the very rich people. And I would take that money just to make it persuasive and say, oh, hey, that's going to cost, if we extend it to the rich people, that's going to cost us X billion dollars. And given the whole problems of the economy, you're willing to spend that X billion dollars. I'd rather take that X billion dollars and do some of the infrastructure that we sorely need in this country. This is not the U.S. Congress.
How about up in the top?
To what extent do you believe the synthetic investment vehicles, the extreme derivatives, the credit default swaps contributed to the downturn and the problems we've had the last 2 to 3, 4 years?
Well, I don't think there's any doubt that whatever the value of those instruments are, in particular cases, in credit default swaps providing protection for somebody against the bond loss, the volume of that stuff, the complexity of it is mind-numbing. And the interconnections and interdependencies that arose in the complicated structure of the market, the obscurity that was inherent in all this, greatly complicated the financial crash.
Would we be better off without them?
I hate to be so radical with that. No, it's all a matter of, did they get overused? I didn't get overused. You get a little academic about it, but there's some analysis that I think has a lot of truth to it. There's a so-called principal agency problem, where the people ultimately making the investments, the people in pension funds and mutual funds or whatever, are doing it through an array of financial intermediaries that are presumably working for the investor, but they have a lot of interest in doing a lot of manipulation that provides a lot of fees in the process. And all those fees mount up, 2% here, 1% there, 0.5% the other place, billions of dollars around, makes New York City rich.
Sir?
Thank you.
Go ahead.
Yes, thanks. Thank you very much, Chairman Vogler. I was wondering about the right hot on the heels of the G20 in Seoul when China and Germany were scandalized about the $600 billion being printed up for our purposes. It came out that the Federal Reserve lent lots and lots of money to European banks. And I don't think that's bad. And I just want to ask you in a way, is the Fed kind of like Princeton, no longer just being in service to the nation, but in service to the nations?
Plural.
Plural.
Well, you're describing they lent a lot of money, no question about that. They thought they were saving the world, and clearly they thought it was necessary to pounce in there with all the army and all the strength that they had, and they did so, and I think it's hard to question that. Now, what you're describing points to some needed reform. The fact that they protected European banks, or not just European banks, these big banks now are very much international creatures. American banks are operating abroad, and the European banks are operating here, and there is no established doctrine, there are no established rules as to whose responsibility it is when one of these big banks goes bad in terms of the operations that it has outside of its home country. In the midst of the crisis, a decision was obviously made. Well, it would have been nice for the Bank of England to bail out the Royal Bank of Scotland, but the Bank of England wasn't about to do it, and here it is on our doorstep, or whatever the bank was, so we better do it. I understand that. And it was, of course, those are institutions that incorporated in the United States. But one of the unresolved, totally unresolved problems of the financial reform is precisely sorting out this question. Who is responsible for what when you have complicated international institutions? Now, another aspect is all this question about moral hazard and bailing out people and calling upon the taxpayer to rescue big institutions that are making a lot of money. Big central problem of financial reform. And here, the design is pretty clear to me anyway, but I don't know how much the public understands it. The effort is to say, let us develop the ability to let a financial or even a non-financial institution in effect go bankrupt without disturbing the market or with a minimal disturbance of the market, because we will arrange an institution that has the capacity to take the institution over overnight and meet any immediate obligation that's necessary to keep the market functioning, but basically liquidate the institution. The stockholders lose, the management loses, the creditors are put in jeopardy, but you handle this to a government process and control. Now, we didn't have that in this situation, so people had to deal with the situation as it was, as they saw it, and they thought they couldn't let these institutions fail without a spreading panic. And they clearly had good reason to fear this. But you ended up with some very odd names there. I agree. I'm not so thinking so much of the names of those big banks where clearly, if they went broke, they would have a problem. But they're actually, I mean, at the extreme, this is General Electric, the great AAA manufacturing company in the United States, has a finance company that almost bankrupted them, and the government rescued it. I mean, we should not, in my opinion, have a system where the government has to rescue the financial arm of a strong AAA financial industrial firm. But that's what we had, and they felt they had to respond to it. Now, I suspect that in the future, General Electric will not have such a big financial arm, but they ought not at least have the expectation that the government's going to bail it out if it gets in trouble. Now, say in general, financial institutions should not have that expectation because now we're better off dealing with it. Now you can tell me, and I would agree, that not everybody is convinced of the workability of that system. And particularly, you've got to have some kind of fail-safe arrangement, in my view, for the really important financial institutions. And at this point, now I'm getting into my own philosophy, at this point, those financial institutions that must be preserved are the basic banking system, the commercial, old-fashioned, it used to be old-fashioned banking system, because that provides a service for the economy that really is essential. So we've built through the years a whole big apparatus for protecting banks. I think quite properly, and that's going to be strengthened. It is being strengthened. And new rules for the banks, more capital requirements. Now, I just want to make a distinction between those that we want to protect and save and those that we don't want to. And that's why I get into this business about the so-called local law. I don't want the banks doing things that other people can do. It's all right, but nothing the matter with the activity, but it shouldn't be by a protected institution that's relying upon the taxpayer. So we'll see how that works out. But that's taken. Now, all these things become clear during the crisis. At the extreme, you have these Icelandic banks. Iceland has 300,000 people. A couple of their banks grew to some big size. I don't remember the number, but mostly in the UK and in some other European countries. And the banks were all out of proportion to the size of the country and the strength of the country. And they were very aggressive and they went broke. In the short run, the British and I guess the Dutch were worried enough, so they said, we're going to have to make good on liability, at least the deposit liabilities of these Icelandic banks, because they happen to be operating in Britain. An extreme example of what you're concerned about. And then they actually said, if we spend all this money to rescue your banks, Iceland, you pay us back. And Iceland said, it was very nice, but we haven't got enough money to pay you back, even if we wanted to. And the bank was operating in your area, and I don't know if they've ever resolved it. They certainly have, I think they maybe promised to pay back something, but some limited fraction of what the loss was. Now you have that all in spades. What's going on in Europe is very interesting. But you have this pattern kind of repeated. Ireland, it's got only one letter different. Iceland, Ireland. It's about 2.5 million people different, but maybe more than that, 3.5 million people different. But the problem is very much the same. You had some very aggressive Irish banks that made a lot of investments abroad and took a lot of deposits from abroad. And when they basically, I don't know if they're technically insolvent or what they are, but they obviously are illiquid and and can't maintain themselves without government assistance. And the Irish government decided that they would protect it. That was a lot of money for Ireland. And Ireland did not have a particularly large amount of government debt before the government debt before the crisis, but they sure have a big government debt now because they agreed to protect the depositors of these Irish banks that got much bigger than the country in terms of their activities. So now Europe has to come to the rescue of Ireland. And the Germans don't like that much because they're the principal strength in Europe. So you have very interesting, I think they will come to the rescue. The amounts are getting bigger and bigger. It's not just Ireland. It's Portugal, it's Greece, it's Spain. Oh, see what an easy job you have compared
we are over time, and I want to thank Professor Volcker for coming. Governor said about thanking him for his support of public service, which is something that's very important to the school. Yeah, I know. We didn't get into that. Good. And then finally also thank Governor Corzine for his support of this lecture series, and thanks to all of you for coming.